Hey guys, welcome back. In today's video, we are talking about Adam Aron's prediction, the 1.7 billion synthetic shares today, wiping out the shorts, and many more in this video. Firstly, we're taking a look at this. I know from our own losses and reading your comments on X/Twitter how distraught many of you are with falling share prices. So this is Adam Aron directing and talking about the situation on hand. In looking at the likely 2026 industry-wide box office, we still expect it to grow materially over 2025, and that will significantly increase AMC's EBITDA. However, the external macro backdrop around us is terrible. War in the Middle East, world oil prices soaring above $100 per barrel, and other concerns have knocked the Dow Jones average to its lowest point in 5 months and S&P 500 to its lowest point in 4 months. As for AMC, I am optimistic about our power to increase our earnings this year over last year. As for the state of the world, we will all read the news together. Naturally, we all can wish for the best on global development. So Adam Aron is again talking about the share prices. He's trying to answer to everyone. He's obviously acknowledged what is going on and he knows things and he's trying to address this. So firstly, we are seeing AMC today, and this is something that we do need to address. Let's not hide away from it. AMC dropped below $1. We are seeing it sitting at 0.9807. And this is obviously having many people frustrated. Now, whilst I say that, we are still seeing multiple apes who are obviously still buying into AMC. And so there's a big difference between frustration and people giving up. Again, 99% of the apes have not given up, but some may be frustrated, and it's completely okay to be frustrated when you see a stock that is doing perfectly fine, but it's dropping in price, not because of the sentiment, not because of the business itself, not because of the investors, but because the market makers are manipulating it. Now, what we can obviously expect for AMC is that currently we are navigating through the whole industry, the whole economy as a whole, as we're seeing Dow Jones drop, as we're seeing S&P 500 drop. But what we have to expect as well for AMC is, of course, this year, like Adam Aron has said, about the power to increase their earnings over last year. We are seeing the box office improving, we are seeing AMC improving, and bear in mind is that AMC is obviously trying to expand even more, and what we can understand is that we can significantly increase AMC's EBITDA. And so one of the biggest things that I'm expecting this year is that one quarter, I don't know which quarter, no one will probably know which quarter unless you have insider information, but AMC will have made an improvement so big, so massive, that it will suddenly shift the whole tide of things, and you will truly understand everything that AMC has obviously trying to be doing for the last few quarters. And that's what we are obviously expecting for. You have to realize this as well. Adam Aron prioritized survival and liquidity over AMC price. His decision helped the company stay alive at the cost of dilution and weaker stock performance. The short-term squeeze-focused folks likely disappointed. The long-term focused investors, he did what most CEOs would do under extreme distress. And this is something we've talked about. And firstly, we have to understand is that what he did is good for whether you're squeeze focused or if you're long-term focused, because you have to understand, had Adam Aron not done the dilution, not raised money, AMC would have gone bankrupt. And if AMC were to have gone bankrupt, the short sellers would have gotten away with it. The only reason why we still even have the squeeze available to us is because of the fact he kept AMC alive. That's been one of the most important factors we have been talking about for a very long time. The fact that AMC hasn't gone bankrupt, because then the squeeze is still alive. And then of course for the long-term performance, this is also very, very important because it shows the longevity, it shows what AMC can do. Another thing that I want to address quickly, and we've talked about this multiple times in the past as well, which is people who talk about how dilution has allowed AMC to survive, but it also allowed the shorts to get out. But once again, to those I say is that AMC has sold, the shares. But what we've seen is how shorts have created more than 10, 50 billion shares of AMC. From the recent data, we've already seen 1.7 already, and that's not even with the full extent of data. So 1.7 billion synthetics of AMC. Even if AMC were to give out 500 million there will still be 1.2 billion synthetic shares that exist. And so you can understand how dilution has only allowed AMC to survive and not allowed the short sellers to obviously get out. And that's something that I've always highlighted. And you have to realize that, again, people are saying, oh, that this is why I'm not selling. 100+ year strongs, founded in 1920, and it survived multiple eras. It's very, very important, because what we have to realize ultimately is that, again, this is what I've said, some apes may be frustrated, but they are not giving up. And that is the whole point of the investor base. And that's how we understand we are obviously going to survive. Remember, the price of AMC right now isn't due to bad sentiment. It isn't due to investors leaving. It isn't due to bad performance of the company, but purely because they are being suppressed and manipulated by market makers who, if they were to allow true price discovery, would get margin called, would get liquidated. And one big thing in terms of people talking about dilution, you can see here, if shareholders had voted yes in 2021, when Adam Aron tried to sell shares to pay off the company's debt at $56 per share, retail wouldn't be in this situation. One of the things I've seen recently and seen in the past as well is people who are saying that Adam Aron is trying to sell shares now. But remember, he has tried to sell shares at different points. But at those points where it was the most optimal, Adam Aron would have been able to sell less shares, but able to raise more money than this current state, because you can obviously imagine at $56 per share, he would obviously have to, he would be able to sell less and still raise more money, but people voted no. And so you have to understand, it isn't that right now Adam Aron is trying to sell shares, but he has tried to do this at the most optimal time. It's just that he wasn't able to get it to work because people voted against him. And so this isn't to blame anyone, this isn't to say thingies, but you have to realize that this is something that AMC has been trying to do, and is ultimately what kept AMC alive and still fighting. And at the end of the day, AMC retail investors will win. They'll win because theatrical exhibition is not dead, cinema is not dead, and AMC is not dead. 2021 may have been a dead cat bounce, but that bounce allowed AMC to land on its feet. Through weak and in need of nurturing, the community stepped up. And it just goes to show how strong the community is. It just goes to show what we have been doing for the past few years and why ultimately we are going to get to that final spot. Now, one of the things why I believe that AMC will have a great EBITDA this year, why I believe in Adam Aron's prediction, is because if you take a look at this server here, the best viewing experiences: movie theater, streaming on TV, solo watch on laptop. Now, during when I voted, we had 2,000 votes and 85.9% had for movie theater. So we know that people still want to go to movie theater. And so right now is a matter of, is AMC able to be the biggest benefactor of this industry? Are they able to get the biggest shares from the filming industry, from the theater industry? And we already know they're doing well, but they obviously can do better. And so if we see them do even better, you can imagine their EBITDA to also improve. You can see why I believe that the box office will do well. We've already seen some films, for example, Zootopia 2, with a 1.9 billion run at the box office. And now we're seeing how it's obviously going its momentum into streaming. But this just goes on to show that, firstly, streaming and theater industry is something that coexists. And we've already seen with how Netflix is trying to react about their need for filming industry as well. And so it just goes to show that we are still needed and that we are going to be on top. And if you want to look at the manipulation, and why I've said that AMC will do well this year, is that ultimately the movie theater industry is doing well. You can evidently see this from Cinemark, from IMAX. And the only reason why we're not seeing this from AMC is because of the manipulation. And so if you want to see how well the industry actually is doing, take a look at Cinemark, take a look at IMAX. Their price reaction reflects what the true sentiment, if it wasn't for 90% dark pool, to be. And so that's what we should be seeing for AMC as well. We can understand that people are in need of theater stocks. People are in need of theaters. People are optimistic about theaters. And so what we're seeing in Cinemark, the buying, is actually what we're seeing at AMC as well. The only difference is that we're seeing a 40% dark pool versus a 90% dark pool. Hence why AMC is going down. And that's ultimately what we have to fight against. You can see AMC at $1 is the biggest joke on Wall Street right now. Theaters are packed, box office is growing, revenue is up, but the price, nah, let's pretend it's dead. And everything we've already talked about until now, you should already understand about how important this is. And one of the biggest things for why this is happening, again, why focus on manipulation, you can see AMC short interest at 337%. So recently, we've obviously talked about the synthetic short interest. I mentioned this at the start as well. And this was using the data structure to find a way to estimate the synthetic share exposure. And what they do is they're using FTD data, they're using the ratio threshold list, they're using some of the ETFs and that are being borrowed. Some of these things that they are using to obviously then understand and find what the synthetic share exposure is. Now, like I've said, they are not using the full extent of data that is being released, but even then, the fact that they were able to find 1.7 billion shares of AMC shorted, that is already something that's extremely important. You can see here quickly, and again, you can pause the video if you want to look at, they talk about broker data, option flow data, historical FTD records, historical records of the ratio threshold levels, and lending utilization signal data. So this is just an extent of what they're doing. There are, of course, more. We talked about the swaps, the offshore shares, the tokenizations of AMC. There's still so much more, but even then, we're already seeing how crazy this is. And if you want to take a look at some of the FTDs or ETFs, RWM and XRT, the two most common ETFs on the ratio since 2021. Now, is it a coincidence? Of course not, because it includes AMC, it includes GME, and that's the biggest reasons for why it's on this list. Another thing, 72% off exchange again. Once again, take a look at the comparison between Cinemark, between AMC. Take a look at how many shares are being routed into the off exchange and how many shares is being routed to NYSE against these two companies. And then you will see kind of the reason why, despite the fact the industry is doing completely well, why AMC is red and Cinemark is green. Those are the reasons. Furthermore, you can see there are still some short sellers who are holding on to puts of AMC. But what we've seen is that for some of these companies, whilst they have puts, they've actually increased their long exposure. We've seen people like Susquehanna, like Citadel, to actually increase not only calls of AMC, but actual long shares of AMC as well. But at the end of the day, with these put positions, the reason why they are worried is because they understand at any point when AMC rises, when AMC is able to see true price discovery, they will get margin called, and that's why they're trying to protect themselves. I think another thing that's being mentioned is the possibility of a merger, especially at the current market cap. Now, this isn't a rumor. There is no rumor of sorts. This isn't, something that's confirmed. It's just that some people think that this is a possibility. And so if this is the case, this is something that we obviously can see is that it's extremely beneficial for AMC as well. But like I said, there is no clear news on that. You can see on top of the tokenization with GameStop coin at 1.3 trillion. It really just goes to show how crazy this is. And again, we don't know the full extent of how they're using this to trade for themselves. We've seen with the AMC tokens how it was used, at least for FTX, to be used as one-to-one against AMC shares. And that was one of the biggest reasons for why we knew there were synthetic shares of AMC. You can see today, $600 billion wiped out in 50 minutes. This has been a crazy few days, and it's why we said we're navigating this industry together. On top of that, 10-year yield spikes 3% to 4.394. What we see is the UK 10-year yield rise above 5% for the first time since 2008. So two crazy things that's going on right now in two of the biggest kind of financial hubs. We're seeing US, we're seeing UK. This is what's going on right now. And then what we have is JP Morgan saying anywhere from 40 billion to 150 billion of leverage loans package into US collateralized loan obligations could be disrupted by the AI boom. So if you weren't worried about what has already been done with the yield, this is just the cherry on top, and it goes to show the market and its volatility right now. As always, none of this is financial advice, so do take us a grain of salt, and I'll catch you guys next time.